Evil results from manipulations. If you want to keep trying to implement the same program you've used in the past, things will get dicey when the market starts moving in the opposite direction from where you were hoping to suppress prices or influence it for a long time. Here on Silver News Daily, you are observed. Become a subscriber to get more. Silver might be the catalyst that sends the entire financial system tumbling down. Currently, the COMEX is confronted with a problem of such magnitude that it has the potential to set off one of the most intense short squeezes in the annals of contemporary finance. An unprecedented 54 million ounces are being shorted, a level not witnessed in 14 years. Subtle but significant actors are advocating for tangible rather than paper delivery. These days, it's about more than just market games. Both the paper silver illusion and the genuine metal are quickly dissolving. However, this is the topic that is being ignored. Silver has been designated as a vital asset for national security by the United States government. Thus, it is more than just a commodity anymore. That's smart. This is crucial, and the government is now planning to stockpile it. Plus, once that happens, don't expect the general public to be able to purchase silver. When you include in the bond market turmoil in Japan, the UK, and even the US, it becomes clear that a worldwide monetary reset is imminent. It has already been ignited, and the fuse is silver. Everything is building up to a pressure cooker with no escape valve. The COMEX's fissures, the physical supply's evaporation, and the enormous demand from institutions. Furthermore, $100 silver won't merely be conceivable when it blows, it will exhibit restraint. What led us to this point then? For what reason is the COMEX now the epicenter of what may turn out to be the most massive financial crisis in a generation? If you want to know how silver is perceived in the future, you must listen to what I'm about to say. And the part of the curve that goes on forever is unregulated by the government. At the other end of the spectrum, on the 10 or 30-year end of the curve, you'd see the bond market. This is where the market is essentially stating that, sure, treasuries will always be in demand, but at what rate? When discussing interest rate decreases and bringing the front end of the curve down, I believe something similar will happen in the bond market, at least in the US. Already, we noticed it. When they attempted to reduce the short end by 100 basis points a few months ago, the 10-year went up nearly exactly the same amount. We are witnessing that. At this point in time, there is so much debt that interest rates must rise to cover the cost of the underlying currency's poor performance and the interest paid on the yield of the treasuries you purchase, both of which are caused by inflation and the devaluation of the currencies, used to value them on a global scale. This is particularly true now, when it's clear that these nations want to print or inflate their way out of the problem, and the bond market is telling them, you'll have to pay a much higher rate return for us to accept your bonds. I'm not sure if I made that point very clear, but the bond market is more powerful than central planners. The silver market's image of stability is crumbling quickly, and it all starts with COMEX. The assumption that COMEX futures are based on actual silver and that each paper contract may be backed by physical ounces stored in vaults has been widely accepted by traders for a long time. That conviction, however, is already crumbling to dust. Not only is 54 million ounces a large quantity, but it is also the largest short position that COMEX has held in 14 years. This indicates that the system is extremely over-leveraged and the warning light is blinking red. This is the issue. This goes beyond mere speculation. There is a diminishing pool of physical metal upon which these shorts rest, and COMEX is losing metal at a quicker rate than it can replace its own vaults. The trick is about to be exposed as the game of individuals ignoring contracts without demanding delivery is coming to an end. Now that institutions are standing up for physical, the system will collapse as soon as paper holders demand enough of the real metal. This isn't about the price of silver fluctuating by a few dollars, which is why analysts like Andy Schectman are raising red flags. What we're talking about here is the distrust in the system that has kept silver prices low for decades. The original intent of COMEX was to manage prices via leverage, not to pay out on many physical claims. The mask is coming off now that more and more contracts are asking for deliveries. The repercussions will be catastrophic if COMEX fails to fulfill its delivery commitments. The price disparity will widen, paper holders will freak out, and then there will be a stampede for physical silver that will dwarf the GameStop short squeeze. Furthermore, this is no longer hypothetical, it has actually transpired. However, this is only the beginning of the story. The pressure is due to both short interest and delivery demand. In my opinion, this is a genuine bull market because the price is slowly but steadily rising. The current market is different from previous ones, in my opinion, because of the corrections. Unlike in 2011, when a correction would cause the price to fall precipitously and never recover, these corrections are negligible compared to what happened in 2011. We are currently witnessing extremely superficial corrections. Although they may be rather steep, they are short-lived and the price quickly returns. That is a fact of physical demand at the most elite levels that everyone must face. The price is what makes this one unique. The majority of people would have been completely bewildered if you had told them that gold would be worth $3,500. This informs me that we are still in the early stages of this bull market, because it is stunning to me. The biggest money in the world is moving in the opposite direction of the public's sentiment. Therefore, a price that keeps going up without drawing any notice from me is extremely optimistic. In my opinion, this is a very positive sign and a contrarian indicator. What recently transpired at the COMEX has completely dispelled the notion that paper contracts control this market. Silver, in the amount of 42 million ounces, is ready for shipment. Now for the exciting part. Despite September not being officially designated for delivery, this occurred in that month. This is a monumental, not to mention historic figure, and it proves without a doubt one thing. No longer do the major players rely on the paper game. Instead of promises, they desire metal. Something is seriously wrong when you witness large delivery requests outside of the usual schedule. With the expectation that the majority of contracts will be settled in cash or carried over, COMEX has functioned for many years. Institutionalized panic away from intangibles and toward tangibles is indicated by physical demands of 42 million ounces in a non-delivery month. Such a change does not occur in a vacuum. It's the end outcome of constant increasing pressure. Potential purchasers include industrial companies, sovereign wealth funds, and even unscrupulous hedge funds. Due to their inability to represent reality, the paper markets are quickly becoming obsolete. Here is that fact. Silver in its physical form is disappearing. There is a drain on vaults. Limits are being imposed. There is a rationale behind the athletes' demands for delivery. When the panic begins, they will be well aware that there will be an insufficient supply of silver. This is not your average market change. It's only the beginning of a trust crisis. Furthermore, when faith in a paper-based financial system dries up, prices do more than just go up. They explode. Still, we haven't even begun to address the following pressure point, which demonstrates how far off the silver futures market is from actual silver prices. The need is 42 million ounces, but there is another number that is subtly indicating that there is a scarcity at the moment. That becomes a major issue when you have huge short positions. Your squeezes will be brief. When it happens, price movements become truly vertical and parabolic. Nickel is a perfect example, with the exception that they essentially turned all the transactions around. And in my opinion, that is when LBMA's credibility completely evaporated. However, this is the result of intentionally suppressing all of these things and messing with nature. Unrestricted market activity is essential. Suppressing free market freedom and letting these distortions emerge makes free markets seem to achieve equilibrium where it should. This is why every manipulation turns out horribly. Suppressing prices or manipulating markets for lengthy periods of time requires pushing them in the desired direction. Things become really risky if it starts to go in the opposite direction and you persist in sticking to the same application you've used before. And that is the current situation. I think that's going to turn out terribly. And you'll notice that costs skyrocket. You'll witness the collapse of financial institutions like hedge funds and commercial banks due to their foolish decision to short all of these. An existential danger, that is. This may have been the final straw that caused Bear Stearns to go bankrupt. You simply play the long game, in my opinion. Furthermore, we have come this far after a long and difficult road. However, I believe that the majority of individuals would have been pleased if I had informed them a year ago that we would be beginning at $42 in early to mid-2025. In all candor, I believe it's only the start. We still have a ways to go before we can tell where this ends. However, it ought to have been here a very long time ago. From what I can see, both from anecdotal evidence and economic data, as well as the actions of the world's four most powerful countries, China, Russia, and India, there is still a lot of space for growth. They're all devouring silver at the rate of light speed. It would appear that the Americans are now joining in as well, at least on the COMEX. Something will make people pay attention when that hits the retail sector, which I think it will. We won't witness genuine fireworks till then. Plus, we haven't arrived at that point yet. Those of you who are attempting to diversify your holdings before prices spiral out of control will find that to your advantage. An alarmingly loud siren is currently beeping from the silver market. The EFP, or Exchange for Physical Spread, is that alarming noise. Typically, the EFP, which is essentially the price at which a futures contract may be turned into actual deliverable metal, ranges from 15 to 20 cents. But its value has skyrocketed to $1.14 as of late. That isn't a variation. An impasse has formed. An elevated EFP indicates a critical situation. The financial system supporting silver is either experiencing great strain or the LBMA vaults in London are physically very tight. Indeed, it is both. It's not only due to market inefficiencies anymore. The cost of turning paper contracts into physical silver is prohibitive. Despair is the central theme. Minor logistical challenges do not cause this spread to widen. When institutions are vying for the few remaining pieces of silver, a panic ensues behind the scenes and the situation explodes. The market is signaling that there is insufficient metal supply by charging a premium price. Everything is set up for a short squeeze when the price of physical silver becomes significantly uncoupled from futures pricing. Allow me to explain. When genuine silver is selling for a huge premium and the futures price is artificially low, because of manipulation and shorts, the system will be broken eventually by arbitrage. Short sellers will have to either find metal they don't have or repurchase their contracts at exorbitant prices as investors swarm to purchase inexpensive futures and demand physical delivery. The fuses burning is being observed live. The $1.14 EFP is more than just numbers. It's evidence that the physical market for silver is braying more than ever before, while the paper market is running out of steam. The COMEX and the EFP aren't the only ones with problems. SLV, a popular silver investment vehicle, is also sitting on its own nuclear bomb. No, I don't believe so. It is not to keep the price down when you observe 8 Western banks, and I will bring up Ed Steer's chart from a few months ago again, maintaining the most concentrated position of any commodity ever traded on COMEX. It is. But they aren't worried about the price because silver has no price elasticity. A very expensive thing can be made with very little. The final product's cost is far greater than the small incremental price of silver, regardless of whether it's 500 ounces in a multi-million-dollar Tomahawk cruise missile or a fifth, sixth, or eighth of an ounce in an iPhone. It is irrelevant. The more accurate description would be that they've attempted to tramp on it because increasing the price would lead to more demand and there is inadequate supply. Trading on the COMEX and the LBMA have distorted the price. I believe that the increasing price would entice investors and speculators due to the distorted true value. That is not what they desire. The availability of silver reserves, rather than its price, is the main consideration, since it is utilized in such minute quantities in the final product. The availability becomes more important than the price when producing it for all of these essential components. I realize it seems crazy. That being said, I agree with you. There was an effort to bury it. Someone has put a hold on it. There seems to be a mad dash to amass it now that it has been controlled, because it is clearly strategically important. Emphasis is placed, electronics, electrical components, and pretty much anything else that conducts electricity requires it. For use in military hardware, it is essential. Medical devices are essential.